Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through all the market weakness and noise. Today, we're putting Byrna Technologies, ticker BYRN, squarely under the microscope. Their latest earnings report just hit the wire, and we are going to stress test their entire framework. We're going to find out if this company is being built on solid rock or if it's just shifting sand. All right, let's get into it. So right out of the gate, you see the problem. It's this core conflict staring you in the face. On one side, you've got revenue jumping up 11% year over year. I mean, that looks great, right? That's the story they want you to hear. That's what the bulls are shouting about.
Yeah, but hang on a second. Flip the coin over and net income, the actual money they get to keep, just fell off a cliff. It's down 52%. This is the classic growth at any cost play. And look, the market eats up a growth story for sure. But when it's unprofitable growth, that's like trying to build a mansion on a swamp. Sooner or later, the whole thing sinks. And that is the tension we're cracking open today.
So here's our game plan, our blueprint for today's analysis. First, we're going to dig right into that growth paradox. What is really going on there? Then we'll give the bulls their due. We'll lay out their case, this story of aggressive expansion. But we have to ask, can that structure actually handle the weight? Next, we'll let the bears attack, and we'll dig into why profitability is just crumbling. After that, we're running a full-blown stress test on the balance sheet. We're going to see how much pressure this company can really take before something snaps. And then finally, our team here at Iron Financial will deliver the verdict. All right, Section 1, the growth paradox. Look, on the surface, the numbers Byrna's posting, they look like a solid build. It looks like they're laying more bricks, expanding their footprint, really growing the business.
But that's the thing. When you start knocking on the walls, when you start checking the load-bearing beams of the financial statements, you start to find some really concerning structural weaknesses. The headline numbers are telling two completely different, totally contradictory stories.
Okay, let's break this table down because the contrast is, well, it's stark. If you're a bull, your eyes go straight to the top. Net revenue, up 11%, a solid $29 million. Gross profit, that's also up almost 10%. So you're thinking, hey, this looks like a solid build. Things are moving in the right direction.
Whoa, slow down. My eyes go straight to the bottom. Net income got sliced in half. I mean, that's not a yellow flag, that's a 5-alarm fire. And then you look at adjusted EBITDA, the number that really tells you about the health of the core business, and it's down a staggering 27%.
Let's be absolutely clear what this means so it sinks in. They brought in more money through the front door, but their ability to actually make a profit went backwards. That's not a small crack in the plaster. That is a deep, structural fissure running right through the foundation of this company. Okay, so let's put on the bull hat for a minute. Let's really try to understand the story that Byrna's management, especially their new CEO, is trying to sell. And the argument goes like this. We're making strategic, aggressive, and frankly, necessary investments to expand. They believe they aren't just building a company for next quarter. They're laying the foundation for an empire. And the way you do that is by getting your products onto the shelves of major national retailers right now. And this number, this $29 million, this is the cornerstone of the entire bull argument. That 11% year-over-year growth, that is the primary pillar they point to. Why? Because it proves without a doubt that there is real and growing demand for their products. You really can't argue with that top line. More people are buying Byrna gear today than they were a year ago, period. This is the proof of concept. It's the big, solid block of sales growth that underpins the entire bullish thesis. So the next logical question is, where is all that growth coming from? And the answer is, well, look at this explosion. This isn't just some small incremental gain. Dealer sales are up 120%. Retail store sales, even better, up 135%. This isn't just about laying a few more bricks. This is like erecting a massive steel framework for future sales almost overnight.
Right. So what you're really seeing here is a fundamental pivot in their entire strategy. They're shifting gears, moving away from a high margin, but kind of slow to scale direct-to-consumer online model to a lower margin, but potentially massive wholesale model. This is the big strategic bet that this entire company is making.
And this right here illustrates their ground game. They're not just talking about this strategy, they are out there executing on it. They just signed a major deal with Academy Sports and Outdoors. That's a huge player, especially in Texas and the Southeast. They're starting in about 50 stores, but they're aiming to roll out to between 200 and 250 stores by the end of this year. Plus, they've expanded their deal with Murdoch's Ranch and Home Supply out in the Mountain West. So this proves the strategy is real. It's not just talk, it's gaining serious traction with serious retail partners. And here you have it, straight from the horse's mouth. This is the new CEO, Conn Davis. He's saying it plain as day. Our #1 priority is driving deeper penetration across retail and dealer channels. This isn't some happy accident. This is a deliberate top-down company-wide strategy. He is signaling to the entire market that this is where the company is placing all its chips. Now, if you're a bull, this is exactly what you want to hear. It's a clear vision, laser-focused on massive, scalable growth. They're building for the future. Okay, hold on. That's a great story. It really is. It's a beautiful blueprint they've drawn up. But my question is simple. What is the actual cost of all this construction? We've seen the glossy artist rendering of the skyscraper they want to build. Now it's time to talk about the bill. See, the bear case isn't that they aren't growing. The bear case is that they are building this beautiful, shiny structure on a foundation made of sand, and it's costing them an absolute fortune to do it. And this is the question you have to ask yourself. Anybody can grow revenue if they're willing to just light money on fire to do it. Growth is one thing, but profitable growth, that's the only thing that actually matters in the long run. So the heart of the bear case is this deep suspicion that Byrna isn't just chasing growth, they're paying a king's ransom for it. So I'll ask it again. Are they just trading dollars for dimes? And here's the first real crack in the facade. For all the celebration about that growth, they didn't even meet Wall Street's expectations. Think about that. The consensus estimate was for 8 cents of adjusted earnings per share. They delivered just 3 cents. That's not a small miss, that's a huge miss. And even on that top-line revenue number they're so proud of, they still came in over $1 million short of the estimate.
So the point here is crucial. Even by the market's own measuring stick, this big growth story is already under-delivering. It's already showing signs of significant strain.
Now this chart right here, this chart is just devastating for the bull case. Adjusted EBITDA is like the lifeblood of a company's operations. Think of it as the raw cash flow that's being generated by the main business, before all the accounting tricks.
And look at this. A year ago, they generated $3 million. This quarter, despite having 11% higher revenue, that number collapsed to just $2.2 million. This isn't a small dip. This shows you that the core earnings engine of the company is losing power, even as the vehicle is supposedly accelerating. It's like they're stomping on the gas pedal, but the engine is sputtering and choking.
So why? Why is profitability collapsing? This chart right here tells the entire story. It's all about the margin squeeze. Just look at the mix shift. Their highest margin sales, the direct-to-consumer web sales, are down 9%. International sales are down 27%.
Exactly. And where's the growth coming from? It's all coming from that massive 120% increase in the lower margin dealer sales. And you can see the direct result of that trade-off in the gross margin, which has already ticked down from 61% to 60%.
And the takeaway here is absolutely critical. They are making a conscious choice to sacrifice their most profitable customers in exchange for less profitable ones, all in the name of chasing that shiny headline revenue number. And it gets worse. It's not just a margin problem on the goods they sell, it's a spending problem across the board. To get their products into these new retail channels and to support their dealers, their operating expenses shot up by 16% year over year. That's $16.5 million. And most of that increase came from higher advertising and marketing costs. So think about this. They are getting squeezed from both sides. They're making lower margins on their sales, and they're paying higher costs to get those sales in the first place. That is a textbook recipe for financial distress. This whole construction project is running way over budget. All right, so we've looked at the income statement, we've seen the bull's growth blueprint, and we've heard the bear's warnings about a crumbling foundation. Now it's time for a clinical, no-nonsense stress test of the company's actual financial health. We're moving away from the income statement and onto the balance sheet. Let's see how much pressure this structure can actually take before something fundamental breaks. Okay, the very first number you look at in any stress test is cash. How much liquidity does this company have to weather a storm or fund its growth? As of the end of the quarter, Byrna had $9.6 million in cash and marketable securities.
But, on its own, that number doesn't really tell you much. Is that a lot? Is it a little? The real story, the important part, is in the trend. Where is that number going?
And here is the trend. And frankly, it's alarming. At the end of the last quarter, just 3 months ago, they were sitting on $15.5 million in cash. Now it's down to $9.6 million.
Let's just pause and think about that. That means they burned through nearly $6 million of cash in a single quarter. Let's do some quick back-of-the-envelope math. At that burn rate, their $9.6 million in cash gives them a financial runway of less than 2 quarters before they hit zero. That's not just a short runway, that's a critical emergency. This isn't a slow leak, this is a gusher. The clock is ticking, and it's ticking fast.
Now let's look at another critical item on the balance sheet, inventory. They are sitting on a mountain of it, $33.1 million worth. Now, a bull will tell you this is a strength. They'll say, this is great, it means they're stocked up and ready to fill all those new retail channels they're opening. But the bear asks a very different question. Is this product that's actually ready to be sold? Or is this just cash that's been tied up and is now sitting in a warehouse collecting dust? If sales slow down even a little, or if those new retail partners don't order as much as they expect, they will be forced to discount this inventory heavily, and then would absolutely crush their gross margins even further. That mountain of product could very quickly become a millstone around their neck.
Okay, it's time to bring it all home. We've laid out the bull case of aggressive top-line expansion, and we've detailed the bear case of collapsing profitability and a dangerously rapid cash burn. It's time to reconcile that shiny growth story with the harsh financial reality and deliver the final iron financial verdict. Is this foundation solid, or is it fundamentally, dangerously shaky?
But before we deliver that final verdict, it is critical that we look at the new CEO's game plan. To be fair, he's not blind to these issues. He's laid out his priorities. He wants to continue that retail push, sure, but he also wants to broaden the brand's message. And crucially, he talks about improving Byrna.com conversion. That means trying to reclaim some of that high-margin business they've lost. And he talks about establishing a financial algorithm for profitable growth.
Right, and he even admits that their execution needs to be, and I quote, sharper. So the big question for any investor is this. Is this a credible turnaround plan, or is it just too little, too late? Can they reinforce this structure before the cash runs out?
So here it is. This is the final blueprint of Byrna today. On the left side, you've got the structural strengths. The revenue growth is real. It is confirmed. The retail expansion is aggressive, and it's gaining traction with big-name partners. And they do have a strong, recognized brand in their niche. These are the solid support columns of the bull case.
But on the right side, you have some very deep and very serious cracks in that foundation. Profitability isn't just dipping, it's collapsing. The quarterly cash burn is dangerously high. And because of all this, there is significant execution risk. These cracks are not just cosmetic, they're structural, and they threaten the integrity of the entire bullish thesis.
So our verdict at Iron Financial is this. Byrna Technologies is a high-risk renovation project. The new framework they're building, this retail expansion, it looks impressive from the outside, but it is proving to be incredibly expensive. And while they are building higher, the integrity of their financial foundation, their profitability, and their cash flow is not just unproven, it is actively deteriorating right before our eyes. This is a classic show-me story. Don't tell me what you're going to do, show me the results. Look, the new management team is on site, and they are swinging the hammers. There's a lot of activity. But the big question is, will their actions actually reinforce the structure, or will the cost and the disruption of this massive renovation cause the whole thing to collapse under its own weight? For now, our view at Iron Financial is that investors should stay on the sidelines. Let them do the work. Let's see another quarter, maybe 2 of results. In short, wait for the full inspection report before you even think about buying into this property.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.